Our next guest believes we are getting closer to a recession in the coming months, and that October low, not really the low. Let's bring in Canaccord Genuity's chief market strategist, Tony Dwyer. Tony, great to see you. So what kind of low are you bracing for?
So why don't we just give it the data? So you open the show with how the two-year note yield's at the highest of the cycle. We look back since it's been a 500 stock index and since 1957, and the S&P 500 has never made the low of a cycle when it's down more than 19% before the two-year made its peak. So with the two-year making the peak of the cycle so far, that tells you that October low wasn't the low.
Okay, so then in the notes, you say that the higher the two-year yield goes, the more likely we are headed into a recession. So is that, you see that in the cards at this point? And so a recession does what to the markets?
I do, Mel. I think the soft landing scenario is because you couldn't disprove the data yet. In other words, you don't go from super fast to a recession in a tick. So it takes time to get there. So what we're basing our recession call on is the percentage of the yield curves that are inverted is at almost 87%. All you need is 55% of them to be inverted to get into a recession. Even the soft landings of 1966, 1995, and 2016, the composite leading economic indicators were nowhere near as weak as they are now. Anytime the LEIs have been here, you've gone into recession. And then lastly, not just the money supply, but the bank lending standards have tightened to a level that, and the loan demand for C&I loans are at a level that have been associated with recession. So to me, the data is there for a recession. We just haven't had enough time to get there yet.
Hey, Tony, so this is obviously backward looking if you're, you have the data here, but do you have any sense of like when stock market in a bear market usually bottom in and around a recession? Because again, this recession call by a lot of strategists and some investors too has been pushed out a little bit. A lot of people were saying just a couple weeks ago, we're in a new bull market and the bear's over. So I'm just curious, if you're right about the recession, maybe in the back half of 2023, how do the stock markets usually bottom before recessions or in them?
Dan, it's a great question. They've never bottomed before a recession. So the median number of weeks from the beginning of the recession to the S&P 500 low is 23.5 weeks. So that's why this whole call has been about the recession and why it's so important to use that data I mentioned earlier. So we know that when the 2 years making a peak, the S&P has never made the low until after the 2-year peaks, number one. That means the October low isn't it. And we also know that the market has never bottomed before the recession even began. So, but what I want to do, Mel, if I can, is be super clear here. We're over a year into this bear market. I want to attack the next low. You don't get Armageddon negative now. We go back to that October low, and I want to attack it because it'll be when finally bad news will become bad news. And that's typically when you make that recession-based low.
And what takes us out then, Tony? Because I think, well, I mean, we admire your work a great deal. What takes us out from that bear? Like, what are you going to attack on the aggressive side, on the long side?
It's going to be the early cycle names, the financials, the cyclical names, the economically sensitive names. Guy, it's really interesting. The soft landing scenario, to me, is one of it's not the best case scenario because we don't have to guess. We know exactly what's going to happen if you're in a soft landing. Inflation is going to remain elevated. The Fed is going to have to continue to tighten, and the market's going to, and risk is going to get hit. We don't have to guess. That's what happened over the last 2 weeks. So I think what we really need is, unfortunately, to go into a recession to the point where the Fed will lower rates enough that it kickstarts a credit cycle. To Karen's point, not now when we're about to enter a potential negative credit cycle.
So Tony, how does the Fed pivoting, if at all, factor into this sort of recessionary overlay? I mean, a lot of strategists, or I don't want to say a lot, but some are banking on, some market participants certainly banking on some sort of a pivot, some sort of cutting, later on this year or maybe early next year. Does that play into this at all? And does that change your outlook for when the market bottoms?
It doesn't, Mel, only because when I look back, the only time that I can find after a tightening cycle where the Fed pivoted and it was the low was in 1995. The last rate hike happened, I believe, in February of '95. The market was already ripping, and it just kept going straight up for the year. I think it was a 34% year. So when you look at that, it really comes down to you've got to go have the unemployment rate pick up. And you know you're in a recession historically when the unemployment rate is 0.5% for an average of 3 months above the low. So if we get a 3.9% unemployment rate, we know we're in a recession. If we know we're in a recession, we know we should be able to be about to make the low. And that creates the opportunity for a real sustainable bull market and a change in that money. The problem is money. It's not just the thought of money. There's the money system is shut down.
Tony, great to see you. Thanks.
Great to see you, Mel. Thanks, guys.
Tony Dwyer, Canaccord Genuity. Some more bullish people might have argued that the markets had looked through this, that the October low was them pricing in the recession that was yet to come because it's a forward-looking mechanism. Did you ever buy that, Courtney?
I think there's parts of the market that are going to continue to do well, right? I think it's hard to look at the market as a whole. And I do think it's hard because we're looking at talking the soft landing or the hard landing. And the big crux there is what's going to happen with unemployment. And I still do find it tough to see where we're going to get to that higher unemployment right now, because you're seeing, like, even fascinating today, we saw Home Depot came out and nobody liked their earnings, but they're hiring more people and increasing their wages. So that you have a lot of that happening in industries. So yes, you have your big tech firms who are laying off, but there's still plenty of parts of the country who can't hire enough people. And so I don't know what the catalyst is to get there, to bring unemployment up enough to bring us to the recession, to bring us to a harder landing. And yes, it's a possibility, but I'm not convinced it's happening yet.
Yeah, Karen?
I agree. To me, the employment thing is a big. Used to be, 3.4 was absolutely well below what maximum employment used to be, right? Four handle, middle fours maybe. So I would think that this economy can withstand some meaningful move in employment that actually would help the Fed story.
No, it hurts the Fed story. It makes it so much harder for them to, it basically means that Fed funds is going to have a 5 handle for much longer than I think the stock market can endure at the valuations it is at. And just the other thing,
why? Why does
if
more
unemployment remains depressed?
Is that what you're saying?
Yes.
Okay,
I just think it makes the Fed's job really hard. I know you feel the same way. I just think it's just, it's one of those things that, and let's just be frank, okay? We talked about Chipotle a couple weeks ago. They're hiring 15,000 workers in North America. These are workers they can fire so quickly, and they will fire so quickly if there is a recession. So, to me, I just think that with unemployment, if we still get hot readings and we have unemployment below 3.5% or so, it makes the Fed's job that much harder.
I agree. I was saying if unemployment rises.
But she's saying that it's going to stay low forever, right? Isn't that what you're saying? Like, you think that we can actually have a soft or no landing because unemployment's not going to go up.
I can see employment staying lower for longer, correct? But you're right, it does make the Fed's job harder, which is why we probably are going to have higher interest rates for longer. And that's exactly where you need to look at the markets. All these longer duration assets are going to continue to be under pressure. So yes, I think we're saying the same thing.
For June, 5.3% is where Fed funds sit right now. 3 weeks ago, it was 4.9 or something. Like the change in psychology, which is probably what the markets need, it's amazingly fast.
And it's exactly right. It's exactly what they need. It's sort of like the come to Jesus moment where they realize, wait a second, we're not going to get out of this situation as fast as we want to. I'm with you. I don't think unemployment's going to move. The Federal Reserve, I think they want a 5 handle. They would never say that. That's what they need. They're not going to get it. And that's the problem. Because wage growth continues. Inflation is a problem. You're going to see it in the numbers later this week. And they're trying to combat something that everybody seems to think is an easy fix. It's not that easy, which is why rates are going to stay higher for longer. And people are just starting to come to that realization now.